Hey everybody, welcome to the channel. Hope you guys are doing well today. If you're a stablecoin yield farmer out there, you'll definitely want to watch this video in its entirety. Not only will I introduce one of the most lucrative farms for stables on the Polygon network, but I'll end the video outlining some strategies that you can use to lock in your profits. And whether it's these CeFi platforms like Celsius, Nexo, and BlockFi, or DeFi protocols, on a weekly basis, I try to update you guys with the latest yields. The best way for you guys to track all these yield updates is through my free newsletter. And if these DeFi protocols are too risky for you, I also have an interest rate tracker that consolidates yields across multiple CeFi platforms, which also can be accessed through my free newsletter. And if you're interested in joining a community of like-minded individuals who have a strong desire to earn yield on all their crypto assets, then make sure you guys join my Discord channel. Whether you're into general crypto talk, you're into CeFi platforms, or you're into DeFi protocols, you'll definitely find somebody with overlapping interests in my Discord channel. Both the links to my newsletter and my Discord channel can be found in the description below. With the intro out of the way, let's go ahead and dive into this video. Alright, to get this video started, let me give you guys a brief introduction to Iron Finance. This protocol originally launched on the Binance Smart Chain, and it's designed to be a fractionalized stablecoin protocol. Prior to Iron, there were two main types of stablecoins in DeFi. One that was collateralized by crypto assets, and another that was basically collateralized by fiat in a bank account. One example of an over-collateralized stablecoin is DAI. So if you wanted to mint 100 DAI, you would have to send $150 over to the CDP contract. And USDC would be an example of a centralized fiat collateralized stablecoin because USDC is always mintable and redeemable for $1 worth of USD. Now with Iron.Finance, they have a stablecoin called Iron, which is pegged to the dollar, and they have a governance token called Titan. And they're basically a hybridization of the previous two models. The capital required to mint is only partially denominated in other stable assets. The remaining portion is denominated in a volatile asset, which is required as collateral. So what they do is they collateralize a portion of it with USDC, and the remaining portion of it is collateralized with their governance token, Titan. And their objective here is to create a more capital efficient model for collateralizing DeFi stablecoins, and also to create a value capture mechanism for their governance token, Titan. And in that same spirit, they've decided to also use the USDC that's deposited into the protocol and place it into a yield producing vault that feeds the treasury contract. So unlike other protocols or other stable coins that basically lock up the USD and do nothing with it, Iron Finance takes all the USDC deposited to mint Iron stablecoins, and they deposit that USDC balance into Aave to produce a yield, and that yield is disseminated to people depositing their Titan tokens in this vault here. Not only is this model more capital efficient, but it also adds further utility and value to the Titan token. And from a farming perspective, instead of farming the Titan token and dumping it, the yield generated by this vault incentivizes people to stake their token in this vault versus just dumping it for another token. And there's a chance that yield might go up in the future because initially they're going to go ahead and just deposit it in the Aave protocol, but in the future they plan to gradually diversify between various investment options and risk reward profiles. And aside from the stablecoin, they also have other products they plan to release in the future. For example, they plan to come out with partially collateralized synthetic tokens to the Polygon network. They also plan to create their own in-house developed lending platform for both Polygon network and the Binance Smart Chain, which is going to allow users to borrow and lend Iron tokens in their synthetic tokens. And lastly, they have a prediction game that's coming out, and I'm thinking that it's probably going to be very similar to what PancakeSwap launched. If that's true, they're going to probably be launching short-dated binary options trading. Now that I've given you guys a brief introduction, if you guys wanted to earn yield on this platform, there's a few ways to go about it. They have a few high-yielding pools for their governance token. You have Titan/ETH, Titan/Iron, and Titan/Matic. This is probably the least riskiest because it's paired with Iron. And like I mentioned earlier in the video, Iron is designed to be a stablecoin pegged to the dollar. So assuming that it stays pegged to the dollar, this pair should have the least amount of volatility. But if you're open to taking on more volatility, then this pair would probably be most ideal for you. And in either case, you're going to have to go over to SushiSwap to deposit your tokens in order to retrieve your liquidity provision token that you deposit back here on Iron Finance. And an easy way to directly go over to the SushiSwap page to provide liquidity is to just click here at the bottom on Add Liquidity. If you don't have the tokens already, you'll have to swap for them. But once you get your tokens, you provide liquidity on this page, then you go back to this page here and deposit your LP position. Now on a relative basis, the safest farms out of these are going to be the last two here, because unlike Titan, Matic, or ETH that can go up and down in price, Iron is designed to be pegged to the dollar and USDC is pegged to the dollar. Unless there's some sort of catastrophic event with the protocol itself, you're not going to be losing money by depositing your assets into this pool here. And to my knowledge, this is one of the most robust yields you can get on Polygon for your stables. And not only are you getting this APR of 290%, but you're also earning pool fees anytime someone trades between Iron and USDC. And since they're both pegged to the dollar, your IL or impermanent loss is going to be significantly less than any of the pairs that you see up here. And if you're open to taking on additional risk, you could bring your LP over here to adamant.finance. And what they'll do is they'll auto compound your rewards and they'll give you an additional yield paid to you in the ADI token. And if you're interested in learning more about the Adamant protocol, make sure you guys watch my most recent video review by either clicking in the description below or the upper right hand corner of the screen. And the added benefit of getting paid in the ADI token is that as you claim your ADI tokens, those tokens entitle you to cash flow generated by the protocol. So not only are you going to be auto compounding your LP position, you're going to be earning ADI rewards, and as you claim those ADI rewards, those ADI tokens that are vested are going to earn you Quick tokens and Matic tokens. But I do want to highlight that they do take 30% of the auto compounding rewards. So all the Titan tokens that you're making from Iron Finance, 30% of them are going to be eaten by the Adamant protocol. Another place you can go ahead and auto compound your LP position is here on Polycat. By depositing your LP here, they'll go ahead and auto compound it for you, and you can see that your daily yield is going to be almost 1% and your APY is over 1800%. Now, assuming that the APYs on Polycat are accurate, you can see that even if you were to auto compound your Titan tokens yourself, you wouldn't be able to earn as much as if you deposited your LP here on Polycat. Now, to end the video, I'm going to share with you guys a couple strategies that you can pursue in order to secure all your farmed gains. So if you were super conservative, the best thing to do would be to put your money into one of these pools here. And what I would do is take 50% of that and put it here in Polycat, and the remaining 50% I probably put into one of these two vaults here. And all the Titan tokens I earn from here, I'll go ahead and redeposit into this vault here. This way, on Polycat, all my funds are auto compounding and I don't have to touch them at all or worry about them. Here on Iron Finance, I basically get exposure to the Titan token for free, and regardless of the price of the Titan token going up or down, I'm going to be earning a yield paid to me in USDC. This way, in terms of the USDC I have, I'll definitely come up on top. And if the price of the Titan token goes up significantly, I'll also be able to capitalize on that. Now, a higher risk strategy would be getting exposure to the Titan token and the Matic token and LPing in this pool here. And I would only do this if I expected the price of the Titan token and Matic token to go up over time. Because if the Titan token price craters or Matic's token price craters, you're going to suffer significant losses. But on the other hand, let's say, it has a good couple weeks, you make your deposit and you're generating yield paid you in the Titan token. Depending on how you feel about the Titan token, you can cash out 50 to 80% of it, deposit the profits from that sale into one of these two pools. That way you're generating a yield on those profits. And the remaining Titan tokens, you can go ahead and put into this vault here. This way you'll benefit if either the price of Titan or Matic token go up. And while you wait, you'll be enjoying a nice APR of 1000+%. And as you get those rewards in Titan tokens, you can lock in the profits, put them to productive use by putting it into one of these vaults here. And the remaining Titan tokens that you're sort of holding for speculative purposes, you can put into this vault. And as those tokens marinate there, they're going to go ahead and earn you a yield paid in USDC. But at some point, I do expect the price of the Titan token to take a big hit, because if you look at the total value locked, it's over 300 million. That means that we definitely have a few whales in here. And because of the highly reflexive nature of crypto investors, once the price takes a sizable hit and a few people get spooked, you're going to see a cascade of selling. Now, this doesn't mean the protocol doesn't have a long-term potential, but I didn't want to mislead you guys into thinking that the recent pump the token's been having is going to be sustainable. And that's the reason behind me outlining those two strategies, because depending on what your risk appetite is, I think there's definitely ways for us to benefit from these lucrative yields and take the appropriate steps to make sure we lock in the profits. And if you're interested in seeing what other people are doing with this protocol and how they're investing, then I would strongly encourage you guys to go ahead and join my Discord channel. And within my Discord channel, I also have 5 private Discord channels where I publish my moves in real time. And even if you join the lowest tier I have on Patreon for $20 a month, you'll be granted access to all the private channels I have. And if you want to take it a step further because you want to expedite your learning about these DeFi protocols, or you needed additional coaching, by joining one of the higher tiers I have on Patreon, you'll be able to get access to me one-on-one. If you feel like any of the services could benefit you, make sure you guys go ahead and click my Patreon link in the description below. With that, I hope you guys enjoyed this video. This is CryptoOneStop signing out. I'll talk to you folks next time. Bye.